If your parents or grandparents owned a home that never really grew in value, that wasn't bad luck, that wasn't coincidence, and it definitely wasn't random. That was redlining. And once you understand what redlining really was and how it worked, you'll never look at neighborhoods, home value, or the wealth gap the same again. This isn't my opinion, this is documented policy. In the 1930s, during the Great Depression, the United States government wanted to stabilize the housing market. So they created the Homeowners Loan Corporation. Their job? To create maps that told banks where it was safe to lend money. These maps used colors. Green meant best, blue was still good, yellow was risky, red was hazardous. And here's the part they don't teach you in school. What determined whether a neighborhood was red? Black people. Not crime, not income, not conditions of the homes, race. If a neighborhood had black residents, even one family, it was often marked red. That meant no mortgages, no refinancing, no home improvement loans, no investment. It didn't matter if the black family was educated. It didn't matter if they had money. It didn't matter if the homes were well kept. The presence of black people alone was considered a financial risk. Let that sink in. Banks weren't guessing, they were following federal guidelines. When a neighborhood is redlined, it slowly suffocates. Homeowners can't access credit, landlords can't improve properties, businesses won't invest, cities won't maintain infrastructure. So buildings deteriorate, schools get less funding, jobs leave, property values stagnate or fall. Then, years later, people look at the neighborhood and say, see, it's a bad area. But the damage came first. The decline was manufactured. While black neighborhoods were being cut off, white neighborhoods were being flooded with opportunity. Low interest mortgages, FHA backed loans, new development, suburban expansion. Homes were being bought for $8,000, $10,000, $15,000. Those same homes are now worth hundreds of thousands or millions. That's not magic, that's compounding appreciation. Redlining didn't just block black wealth, it supercharged white wealth. And you know what's crazy? This wasn't a secret. This wasn't underground. This wasn't like rogue bankers. This was legal. This was policy. This was backed by the government. Real estate agents participated. Banks enforced it. Appraisers followed it. Cities planned around it. So when people say that was a long time ago, understand this. Homes bought in the 1950s are still funding lives today. So now, redlining officially ended, but the damage didn't reset. Many neighborhoods today that are labeled undervalued, high risk, or even up and coming were redlined 80 years ago. And here's the kicker. When those same neighborhoods finally become desirable, the original residents, the ones that were there from the beginning, are often priced out. That's not coincidence. That's the long tail of redlining. This is why we still see appraisal gaps in black neighborhoods, lower equity growth, higher interest rates for black borrowers, even when income and credits are similar. Redlining taught the system how to undervalue black space. That lesson never fully left. And me, I never played a victim. This video isn't about staying stuck in the past. It's about understanding the rules. Because once you know how the game was rigged, you can learn how to move smarter inside it. Ownership still matters. Equity still matters. Real estate is still one of the strongest wealth tools available. But black families have to move with awareness, not assumptions. In the next video, we're talking about the moment when America created the largest middle class in history and why black Americans were locked out of it. The GI Bill, the suburbs, the post-war housing boom. If you think redlining was damaging, wait until you see what came next. Subscribe, stay with me, and share this with someone who needs context, not blame. Ownership starts with understanding.